For decades, private equity was the darling of pension funds, university endowments, and sovereign wealth funds. It promised high returns, low volatility, and maybe even better companies in the bargain. And now the Trump administration has just made it possible for ordinary investors to get some of the magic. On August 7th, Trump issued a presidential action entitled Democratizing Access to Alternative Assets for 401k Investors. His action went on to say, my administration will relieve the regulatory burdens and litigation risk that impede American workers' retirement accounts from achieving the competitive returns and asset diversification necessary to secure a dignified, comfortable retirement. Luigi, isn't that exciting?
You don't need to be a psychologist to hear some sarcasm in your voice. But you're right, the timing is a bit ironic, to say the least, because Trump's rulings come just as long-standing questions about private equity are coming to the fore. Like why distribution has slowed to a trickle, why the data actually, what the data actually say about performance, and where is the industry headed to?
This whole thing does sound Ponzi-ish to me, but instead of me just sounding off, let's talk to someone far more knowledgeable. Dan Rasmussen, who began his career in private equity inside the belly of the beast, he worked for Bain, has emerged as one of the most prescient critics of the industry. In a recent piece for the Financial Times, he wrote this: the consensus on private equity is being quietly but decisively written. The question now is not whether the model is being broken, it's whether the exit is wide enough for everyone trying to leave. Dan is also the founder of Verdad Advisors, an investment firm with over $1 billion under management, and he's the author of The Humble Investor and American Uprising. We're delighted to welcome him to Capitalisn't. I thought just to start at the very beginning, what is it that made you start investigating private equity?
Yeah, so my first job out of college was working in private equity. So I spent 4 years in the industry, and I got assigned to look at what had happened during the financial crisis and what had worked and not worked in private equity. And so I started looking at private equity from a quantitative angle, and it was a fascinating project. There were three big insights from that early project. The first, the private equity deals are really small relative to the scale of public equity markets. So, to frame this in terms of numbers, right? You think of like the S&P 500 of having a market cap of about 50 trillion. So 500 companies, about 50 trillion of market cap. The Russell 2000, which is 4 times as many companies, which is the small cap index, has a market cap of about 2 trillion. Private equity, there are about 12,000 private equity backed companies, and the market cap of all of those is about 2.4 trillion. The second thing is that these tiny companies, the sort of origins of private equity, they used to call it leverage buyouts, right? It's using debt to buy companies. So these companies are not only very small, but they're very levered. And when you contextualize that with the public markets, the S&P 500 companies are barely levered at all, right? Apple has cash, not debt. But the typical private equity firm, private equity backed company is about 60% debt finance. You kind of back into these numbers by looking at the size of the private credit market, which is called 3 trillion. So it's bigger than the private equity market now. And so, and that roughly parallels, right? You have 2 trillion of equity and 3 trillion of debt sitting on top of these 12,000 really small companies. And that's the private equity asset class. The sort of third insight from the study was that comparing valuation multiples and saying how much do you pay for one of these small private companies, how much do you pay for a public company, and for kind of 20 years or so, from the 80s till the early 2000s, private equity was buying companies at about a 40% discount to the public markets, which makes sense, right? You're buying a tiny subscale company that is not big enough to have caught attention of other people. You should pay a lower price for it. You're paying it at an illiquidity discount, which is how you earn your illiquidity premium. And then you could go and sell it. The good ones you could sell to a strategic for a higher valuation, or you could IPO them at a higher valuation, right? And there was this natural process. And if you were really good and you got one of your guys promoted from the minor leagues to the major leagues, you made a lot of money, right? And that was the model. But probably in 2005, 6, right before the financial crisis, what happened is that private equity started to get more popular and deal valuations started to converge. So instead of paying that 40% discount, all of a sudden you were starting to pay sort of actually quite normal prices for private businesses, not that cheap bargains that you had before. And then post 2010, and really in the last 15 years, you've seen private equity valuations go through the roof to where it's more expensive to buy a private company than it is to buy a public company, because every company is going up for auction and there are 20 or 50 or 100 bidders because everybody and their mother is a private equity firm now. And, again, if you sort of take that 2 trillion number relative to 50 trillion for the S&P 500, you come to a sense of like, okay, if I'm sort of index weighting, I should have about 4% of my US public equity allocation in private equity, something like that, 4 or 5%, right? And if I'm 60-40 stocks bonds, then maybe I should have 3% of my overall portfolio in private equity. But you look at what the quote unquote smartest people in the room are doing, and they're putting 40, 45, 50% of their portfolios in private equity. Like you look at Yale, Harvard, Brown. And by the way, like you go down the top 10 college endowments and look what percent they have in private equity. It's all like 40%. There's no outliers. There's no divergence. It is complete consensus groupthink that you should have 40 or 50% of your money in these tiny, tiny little really levered companies. And how everybody came to that conclusion and why there's no disagreement, I don't know, but it is true. And I think the sort of basic logic and facts, when you sort of hear why all this money has been going into this tiny set of tiny companies, and you try to figure out how people are going to make money off it, you're sort of like, well, why am I going to earn such higher returns by paying 2 and 20 fees, to buy tiny little companies at higher prices than public markets using a lot of debt, when those companies are mostly small and low margin? People talk about foreign stocks and they say, well, I don't want to invest in Europe because there's no European Google. There's no European NVIDIA. It's like, well, there's no private NVIDIA. There's no private Google. So why are you putting 40% of your money in privates? Like these are subscale, relatively crappy companies. And yet, investing massively overweight to this stuff is the best idea that all of our smart allocator friends have had.
Let me play the devil's advocate. I think if you are Yale or if you are a large endowment, you don't have any comparative advantage in investing in the public market, but you have two comparative advantages. One is disappearing, but two comparative advantages in investing in private market. The first one is that you're not supposed to have any major shock. Before Trump, universities did not have any liquidity shock, and so they could afford to lock in capital for 10 years. That's one source of comparative advantage. Second, they actually know their alumni very well. It's very difficult to sell information. Okay, this is a point. I know you are a student of Canaro, so Arrow is the first one to point this fact. It's difficult to sell information. However, if you are an alum, you can pretty easily donate information to your alma mater. So, and by the way, there is a level of trust. The comparative advantage of endowments is precisely to invest in private equity. What I don't understand, we're going to come later, why we want to have the individuals invest in private equity. But that's a separate thing. I think at least historically, and maybe 40% is an overdoing, but historically, I saw a reason why they were sort of overweighting that particular segment.
Yeah, so I think that the first idea, there are two, right? The first is the idea that you should get paid for taking on illiquidity, and the second is that you should get paid for superior managerial skill.
Picking good managers, or having the information to pick good managers, yeah.
Yes, and I'd say for the first, my argument would be that to earn an illiquidity premium, you have to purchase at an illiquidity discount. Right? You can't pay more than the public markets for the asset and then expect to earn an illiquidity. Like you paid a premium to buy the asset. Where's the discount, right? Like I think it's really hard to argue that you're getting a discount in private markets today, right? There are just
but I'm
too
sorry,
many private
Dan,
equity
do you
firms.
really believe the accounting numbers of private firms? In a sense, when you buy from an owner, maybe it's because of my Italian origin, but when you buy from an owner, the owner makes everything possible to hide the earnings, right? That's a
Yeah, but I think if you look at, there are a lot of studies by S&P and others that the adjusted EBITDA numbers that private equity assigns to these companies and the models that they use to underwrite their deals tend to be about 30% higher than what actually occurs. So there's about 30% of these add backs that are really kind of phantom. So I'd actually argue that there's a massive overstatement of EBITDA by private equity firms relative to the true cash economics of these businesses. And so I think on top of the, like you're adding back all the stuff and then you're paying quite a premium price. And I think, just it's basic like auction math. Like you only need two parties at an auction to have an efficient market. And if you have 17 parties, what's the case that like one of them is just kind of crazy or desperate? And I think that's the state of private equity today, right? Talk to any mid-market private equity firm and say, tell us about the last 15 sale processes you were in. Were they competitive, not competitive? They'll tell you it's crazy competitive. Like there are way too many private equity firms. And that's not a recipe for earning, for buying things at a discount. And so if you're not buying at a discount, how do you earn a premium, right? Like you're in the most overheated, overbought market there is. You're not getting any bargains. And you have to get a bargain to earn a premium. So I think, yes, great, you have a long view, but that doesn't necessarily get you anything, right? Like unless someone's willing to pay you for it, and they're not. I think that the next thing about managerial skill is the same argument would apply to active public equity management. Like, couldn't you figure out who the best guy at Fidelity was because he went to your alma mater and he calls and tells you? So like, why is it necessary that you do that in private markets? You could do it in public markets too. You could know that Ken Griffin's a really smart guy and invest in Citadel. I don't think that necessitates a shift from public to private, or necessitates any specific asset class just to choose the best people. I think the only argument that private markets maybe might offer in that regard is the idea that these private equity owners are improving the companies that they buy, that they're running them better than other comparable people, and that the source of alpha in private equity is operational improvement. And I have a very healthy skepticism of that idea.
Talk a little bit more about that skepticism of the idea that private equity is delivering operational improvements, because it's documented skepticism. It's not simply my form of skepticism, which is opinion-based skepticism.
Yeah.
Then that was the first study of yours that I had come across years ago.
Yeah. So I like to start with sort of like, again, your sort of basic common sense, like who do the private equity firms hire? Well, it turns out they hire a bunch of investment bankers. And then you say, well, where in your investment banking career did you suddenly learn to run Midwestern industrial businesses, right? Like if operational improvement was the key driver, why don't they hire a bunch of like ex-CEOs to run these companies, or ex-middle managers, or sourcing people, right? In fact, those people are sort of like a serf class within private equity, that they're in the portfolio group, that all the partners are the deal guys, right? So what are they good at? They're doing deals. Like it's not about operational improvements, and never was, except as marketing. But I think that there's a lot of the way I've sort of tried to document this is looking at some portion of a smaller portion these days, but a larger portion historically of private equity deals issue public debt at the time that they do a deal. And when you issue public debt, you have to report the last 3 years of GAAP financials. And then every year that you're issuing debt, that the debt is live and paying a coupon, you have to issue the financials to your bondholders. And so that public data is available for a subset of LBOs that issued public debt. And so you can look at these and say, what did the pre-transaction economics look like? And what do the post-transaction economics looks like? And you can control for sector and whatever, and do this in a pretty robust way, which is what I did. And what you find is that there's revenue growth slows a little bit. And my thesis for that is that private equity firms tend to buy things that look like they're high growth, but growth follows a random walk. So you buy stuff with high growth, and then it follows a random walk, and you end up with a little lower growth than you bought it at. Margins basically flat. But you see a massive increase in debt and interest payments, and a decrease in CapEx spending. And I think that's sort of intuitive, right? Like it's an LBO. What do you expect? Like the reason they took control of the company is to increase the debt. That's what happened. That's what happens in every LBO. What happens in every LBO is an increase in debt. What happens in some LBOs might be an increase in margins, and another a decrease in margins. Some revenue growth increases, but there's no reason systematically to think that private equity, qua private equity, is better at running companies than public company CEOs or families or any other group of people. Otherwise, why wouldn't Harvard at their MBA program teach a whole class on like the private equity cookbook, how to run companies like Blackstone? Because there isn't a cookbook. It's just a bunch of investment bankers that buy companies and then sit on the board and yell at people to make the finances better.
But I don't know how familiar you are with publicly traded companies. There are plenty of inefficiencies. It's not they are perfectly run. And so I can see that having somebody with the right incentive sitting on top of a competent manager, because I think you mischaracterize a little bit in the sense that companies are run by proficient manager. You call them serve, but whatever. They make a lot of money, so they're not really exploited the serves. And the only thing that the LBO's organization do, and then there is a question why they pay so much for that, but the only thing they do is they maintain some financial discipline and allow the firm to carry a huge amount of debt. In a sense, debt, even after the tax reform, that is tax favored. Before it was even more. So now you might argue that this is bad for society, but that's in a sense the fault of Congress that favor debt. There's a huge advantage of having debt from a tax point of view. The cost of having this debt is that when the proverbial S is the fan, you find it difficult to raise funds. If you have somebody on top of you that provides you the fund in those moments because they know and they trust you, then they allow you to run the company at a much, much higher leverage, which is, from a tax point of view, enormously efficient.
Yeah, so I'm sympathetic to that argument, Luigi, in that I think that there's no question, it's very well documented that private equity sponsored companies are able to access the debt markets in a much more effective and efficient way. They get better terms, they get more forbearance when things go badly, they're able to take on more debt. They get treated better in restructurings. And I think that's consistent with my view that what is the private equity operational value add? It's that they are ex-LBO and that they're ex-investment bankers who, unsurprisingly, really know well how to do acquisitions and manage debt capital markets, right? So I buy into that thesis completely, and I think that's one of the good things about private equity. I think, however, as a class, private equity backed companies run at much lower margins at almost every level than public companies, right? They're much lower margin. Part of that structural, they're tiny little companies and less diversified, less scaled than public companies. So I think it's hard to argue that they're, higher quality companies, right? Like, the highest quality companies are obviously in public markets and the higher margin companies are in public markets. Yes, the private companies can be managed to hold a lot of debt, but that doesn't make them better run, more efficient, higher margin companies. They're certainly not that. And I think that debt, and I think it's sort of central to thinking about the private markets, that debt in good times in a market that's going up can be a lever to the upside. But when things go badly, obviously it's a tremendous problem to be very levered, right? You have a lot more downside risk, a lot higher bankruptcy, et cetera. And I think it bringing us to this current moment where the S&P 500 is at all-time highs and the stock market is booming and the economy seems to be booming. And for some reason, private equity can't sell their deals, right? Like they can't exit their deals. And you're like, well, if these companies are so good, why can't you sell them, right? Like it seems like a good time to sell. Like it seems like the public market's doing fine, IPO market's open. Maybe these companies just aren't that good, or maybe they paid too high prices for them, right? I mean, that's, I think, the sad truth here.
So let's go to that. Maybe Luigi is right, and maybe private equity is the best thing ever, and these managers all deserve to be making fortunes.
That. You're mischaracterizing.
And maybe I'm just a mean cynic who doesn't like private equity. Let's put all that aside. Regardless of whether it's good or bad, we're in this moment now where private equity can't sell its deals, where the distributions aren't coming back to the underlying investors. So what's happening? Talk us through the signs that you see of what's happening to the industry right now.
Yeah, so distribution to paid in DPI is typically about 30% of NAV. So 30%, you have 100 million invested every year, you're going to get back 30 million or so in aggregate, right? That's dropped to 10. So distributions have just collapsed. And so you say, well, why have distributions collapsed? And to figure out that, you have to go and say, well, what are the traditional paths to exiting private equity deals? And there are generally three paths. They've added a fourth, and we'll talk about that. But the first, the biggest, is a sale to other private equity firms. So that's about 40 to 50% of private equity exits are to other private equity sponsors. And fundraising is down for the third year in a row. So as long as the asset class is growing, you can always exit to somebody at a higher valuation. The asset class starts shrinking, that there's pressure on that exit path. The second is selling to strategics. So, there's, I think, no reason that, strategics wouldn't be buying right now, other than that, for some reason, the assets were not the assets they wanted. But right now, that's, there's not been a lot of strategic exits. And then third is IPOs. And generally, a small percentage of private equity deals are big enough to IPO, and even those will IPO into the small cap market. And so, basically, your buyer is the small cap active public equity manager. And there are generally a few things about private equity backed IPOs that small cap managers don't like. One is that they tend to IPO, and then the private equity sponsor still owns 70 or 80% of the equity, and they're going to have to sell that down. So you're looking at this big overhang on the stock. And then second, it's usually got a lot of debt, and public markets don't love really levered firms for a whole variety of reasons. Even though Luigi says they're very much more efficient to run in a taxable way, but public market investors hate them. So the market votes no. And then I think third is just like, do you know any small cap active public equity managers? Like, I don't know. There aren't that many left, and there are a lot of private equity guys. So the sort of there's a lot of these and not that many of these. And so I think all of those have been under pressure. And I think that what's emerged as a result is a boom in the secondary market. So either people selling their private equity stakes to secondary firms, and the secondary firms are great. I love this because the accounting rules allow them to buy something at 70 or 80 cents in the dollar on Tuesday and market at 1 on a Wednesday. Because you don't have to incorporate transacted values into your calculation of what a private equity stake is worth. It's always marked at NAV. So you could even buy something at 10 cents in the dollar on Tuesday, and accounting rules allow you to market at 1 on a Wednesday. So the private equity secondary firms always look like they're making money and earning an IRR. And so that's become a very positive area of growth. And then the private equity firms themselves doing continuation vehicles where they say, we're going to take this and we're going to sell it to another fund we control that's dedicated to this thing or a group of these things, and you can exit, or we'll bring in new investors and we'll continue owning it because we can't sell it to a third party. And all of these things have emerged to sort of fill the gap. But at the end of the day, they haven't been enough of those to close this sort of DPI gap that's opened up of late.
But again, I don't want to be seen as the defending private equity, but I like to play the devil's advocate role. So, at some level, you can argue, number one, that our friend Lina Khan had a lot to do with the fact that strategic acquisitions are down. And the way they were making money is by helping consolidating industries. And once you start to resurrect the antitrust, that channel is down. It's done for a good reason. And a real reason. The second is there is a general. This is for another podcast, but there is a general downtrend in IPOs, and some people claim that the diffusion of indexing that we academics have pushed very hard has made it very difficult for new firms to come to market, and as a result, the IPO channel is down. And the fundraising, in part, unfortunately, there is a bit of a Ponzi scheme element of that the more you can sell, the more you can raise, the more you can raise, the more you can sell, and so on and so forth. But two, I think that the attack to university by Trump had a devastating effect on fundraising because Harvard needs to be very liquid. And the last thing you want to do when you're very liquid is to fund private equity. And of course, all the universities are attacked at the same time, or they feel the threat of being attacked. And so the risk of a dramatic reduction in commitment is a reality because unfortunately, and this is one of the problems, this market is becoming too dependent on university endowments and is suffering a big consequence. So the combination of all three things together happening at the same time is really a big threat for the industry in this moment.
Yeah.
But wasn't fundraising down well before Trump came into office? Hasn't it been falling for the last bunch of years? And then go ahead and answer.
Yeah, I think it fell. I mean, I think it fell in 23 from 22, and 24 from 23, and 25 is down from. So I think it predated Trump, but I think Trump has definitely added to it. But I think part of it was the distributions dried up even before Trump. And that was a big driver. Sort of redeployed assets is always a big driver of the fundraising cycle. I got this back, and now I give it back. I deploy it into your next fund. But I think that for an asset class to be so dependent on flows isn't good, right? If you need the asset class to grow, as that fundraising needs to be good for your returns to be okay. That's not necessarily a good thing.
Am I wrong in thinking that it was a sign of problems to come that the volume of private equity deals sold to other private equity companies had been so high for such a long period of time? I want to say it peaked at around 45% back in 2022. And isn't that already a problem? I mean, maybe I'm being too harsh, but isn't it a problem if you don't have an honest exit of being sold either to the public market because investors want this company, or being sold to a strategic buyer because you've built such a good company that another strategic buyer wants it, and instead you have to sell to another private equity firm? Or am I being too cynical?
Yeah, well, I think that I think the sort of other way of looking at it is it's sort of interesting that private equity was offering the best price for these assets. Like, what does that
Right.
sort of mean, right? Like, if and by the way, if you think there's operational improvement and 45% of deals are sponsor to sponsor, does every private equity firm improve it from the one before it, or does only the first one get the operational improvement, right? Like, when does it happen? Who captures the value? And doesn't it sort of challenge the thesis that operational improvement's what's driving this, if in fact most of these assets are flipped from sponsor to sponsor to sponsor? But I think that ultimately the reason they sold was it was the best price, and it was the best price for two reasons. One, that all the private equity firms had raised a boatload of money, and two, that private credit was willing to lend at ridiculous terms. And so why not pay big prices? And part of the reason that private equity sponsors can't pay as big prices now is because all the private credit loans are floating rate. So you're getting materially worse terms on the debt because of the rise in interest rates, and so that's pulling into valuations in a big way. Even though spreads have compressed, the underlying rise in rates has been really problematic.
So I saw on your newsletter, which is very interesting, some interesting analysis of publicly traded private equity firm, particularly in England. And you are making some interesting inference about what it means for volatility and so on and so forth. And one question that I had is when you look at one of them, the value of what you see traded is not just the value of the asset in place, but also the value of the future growth opportunities. So when you see that they trade at a big discount on net asset value, it's not just that the assets in place are not worth much, it's also the fact that you expect that the continuation value is very low. So if the industry is shrinking or does not have a good prospect in the future, this will weight down the valuation. And so all the volatility and also the beta and all these things are impacted by these future opportunities that have not nothing to do, but relatively little to do with the asset in place value. No?
Yeah, so I think these, this London listed funds are fascinating, right? Where you see actual private equity funds being traded in the public stock market. Which, by the way, if private equity gets put into 401ks, it's going to look a lot like what's going on in London, right? Because it'll have to be in some sort of closed end vehicle that trades either premium or discount to NAV, whether it's like an interval fund where it trades monthly or whether it trades on daily pricing. You're moving from sort of the quarterly NAVs and complete illiquidity to a world where you have to provide the 401ks the ability to trade either on a monthly or daily basis. So it's going to be looking like a closed end fund, like these London listed vehicles. And so I think they're a really interesting analog to think about what happens if retail gets large access, or these access vehicles get created, and how they're going to trade. And what you see in London is that these vehicles traded today at about a 30% discount to their NAV value. And that's really quite interesting because the secondary market trades at maybe a 10% discount to net asset value. And the secondary market is obviously sort of, a college endowment selling a portfolio, a one-time thing to a secondary firm. But these London listed vehicles are daily traded, and they're always quoted. And so it's really interesting they trade at a 30% discount when secondaries trade at 10. Because what it's saying is that public markets have lost a lot of confidence that these NAVs are particularly accurate, or perhaps the duration at which they think those NAVs are going to be realized in actual cash flows has been extended. But what's interesting about these London listed funds is that they're much more volatile than the public equities generally. which makes sense because the underlying companies are really small and levered and opaque. And they have bigger drawdowns. They trade at a big discount to the NAV. And none of this, I think, bodes well for the inclusion of private assets in retail portfolios. I think if these London listed vehicles are any indication, that they're going to be these private equity things are going to be treated like other closed end funds, which is, as someone once described them, they're sold, not bought. That you get sold them, and then the minute after you're sold them, they trade at a big discount because there's no natural buyer out there for the assets on the market once you've been sold them. And I think that's likely what happens with these private equity closed end funds, which is likely, or interval funds that are going to get stuffed into 401ks.
So let's go to that question of how private equity gets into 401ks. Does it have to be through some kind of closed-end fund vehicle? Is that what all these firms are going to set up? And then I guess as a corollary question, the cynic in me thinks when they come for our money, it's not because they're helping us, it's because they need our money, because the institutional market is close to tapped out, and so they need another source of growth. And do you think that's fair? How much of this push into the retail market, especially on the part of big PE firms, is because they're doing us an enormous favor and helping us all get rich and save for our retirement? And how much is it because they're at this place in the previous business model where they need fresh money?
Yeah, well, I think as Luigi described, I mean, the college endowments were the original buyers, are stuffed to the gills with this stuff already. They want less of it, not more. Private equity has been bailed out by interest from the Middle East, which has bought a lot of, if you went through some of these large private equity firms and asked what percent of their investors from the Middle East, it's a shockingly high percentage. So they've been sort of that customer group has replaced the college endowments. How long will it be till all the sheikhs are stuffed to the gills with private equity and don't want any more? I don't know, but we're probably pretty close to that. And then they need a new market for growth, and that's largely retail. By the way, insurance was another one. Buying insurance firms or getting insurance assets invested in private equity or private credit, that was a big growth area as well. Now that's sort of tapped out, and so the next venue is private, is retail. And now they've been going to retail through things like iCapital for years. So I tend to think that all of the sort of quote unquote sophisticated high-end multifamily offices and those sorts of things, anyone that wanted private equity could get private equity. It's not been hard to access as a retail investor if you had a certain amount of assets and were with a certain tier of financial advisors. You could get it if you wanted it. Whether you wanted it, who knows? But it's been accessible. I think what they're now trying to do is essentially create vehicles that are even more accessible, which means this sort of closed-end fund structure where it's going to be able to be traded on a daily or monthly basis and stuffed into the 401k plans. And I think that's a rather worrisome development. I think in part, I think we have to think about fees. Fees matter. Alphas are scarce. Fees are certain. How much alpha is there? And can 2 and 20 type fee structure, is that sort of surmountable in the private markets, and how are they going to surmount it? And by the way, it's not just going to be 2 and 20, because there are going to have to be some sort of feeder fund fees, and you have to remember their portfolio monitoring fees and all these other underlying fees. So private equity is an enormously high fee strategy. And I think that retail investors, thanks to John Bogle and Vanguard, have been well conditioned to understand the importance of low costs and to feel like they're being robbed every time their financial advisor proposes something very high fee. And so I do think that actually retail investors writ large are going to be fairly skeptical of private equity in their 401ks. I mean, I think that the sort of access pitch of, well, we do have unique access to this private equity vehicle has been a selling point to a certain set of wealthy people, but I'm just not sure it has mass market appeal. I think the optics of private equity for the average American are probably negative, and for the average investor that likes index funds, I just don't know how you're going to go from owning index funds to putting 20 or 30% of your money in a 4, 5, 6, 7% fee load vehicle.
Bethany and I compete on who is most cynical. And in this case, I think I'm more cynical than her, because my big fear is not that George Mark, first of all, George Mark might not even have a 401k, but George Mark with a 401k will wake up in the morning and say, I want to invest in private equity. Unfortunately, he might say, I want to invest in cryptos, but that's a different story. So how do these people get to put private equity into their portfolio? I think that, there are a lot of various index like target retirement fund, opaque things that are market heavily by the various provider of the 401ks. And if the providers are paid enough, they're going to stuff this stuff without us knowing. And whether you believe in the past that private equity was good or bad is irrelevant at this point. This point is it's facing, in my view, a crisis in this moment, precisely because the expansion phase is finished. And you're right, it's not just the attack of Trump to university, but they went from 0 to 40%. They can't go above 40% even without Trump, okay? Yep. So the expansion phase is finished. And you run out of shakes to dump this stuff to. And who are the leftovers? Us. And it says, I think that this is the biggest bailout of Wall Street done by American taxpayers, certainly since the one in 2008, but probably more even historically.
Yeah, I think that's exactly right, and I think it's a very worrisome development. But I think that there are enough skeptical voices. I like to think the American people are more sort of diversity of opinion than your average university endowment staff. So I'm hopeful actually that that this push into retail will not go as well as private equity titans are expecting. But I do think you're right that they're going to try to stuff it into the target date funds. And they'll say, the 2045, 2050 target date fund is going to have a 20% allocation to PE, and that'll scale back over time. And that's how they'll do it. They won't sort of, but I think to the extent that those funds do start trading in any sort of liquid way, the discounts are going to shock people because they're going to say, wait a second, why is that thing that I invested in at 100 cents in the dollar now trading at 80 cents in the dollar? And that's going to weigh on performance. And I think already you're seeing that endowments and foundations, smaller endowments, which did not do as much private equity for a whole variety of reasons, are outperforming the larger endowments and have been for the last 3 to 5 years. And they're doing so because they have less private equity. Private equity is now a drag. It's a meaningful drag, just like hedge funds used to be on large endowments. And so I think you're selling people on an asset class that actually has bad trailing performance numbers or worse trailing performance number than the low fee index fund. I don't think that's that compelling.
Can you guys explain to me? I actually don't understand the concept of being able to stuff this stuff into target date funds. Can someone explain that to me so that both I and all of our listeners know what to look out for?
Yeah, so I think the idea is, so there are these target date funds, and essentially what they do is they say, you're going to retire in 2065. You put your money in this fund, and then we will manage all the underlying investments, and the asset allocation will change over time as you get older. And so there'll be a lot of equities early on, and there'll be a lot of bonds closer to 2065, and we're going to change it and adapt it. And so all you're going to see as a line item in your portfolio is like BlackRock 2065 retirement plan. And I think that's where you could stuff a private equity fund in, and nobody would notice because they don't see private equity as a line item in their portfolio. They just see a target date fund in their portfolio. And they don't know what's the underlying composition is.
And who runs the big target date funds?
All the big asset managers have big target fund businesses. It's a very common way of providing retirement accounts or retirement vehicles.
Do the big Wall Street firms have big target?
Of course. Vanguard, BlackRock, everybody.
Goldman and Morgan Stanley and Merrill Lynch as well?
I imagine so. I don't know every single one, but...
Okay. Because I think that's part of my fear of the corruption here is that, and I think it actually, when you mentioned the financial crisis, I started to think it actually is really interesting. So let me just lay something out and see what you guys both react to this. But, private equity has for years now been the biggest fee payer on Wall Street by far. And so all the Wall Street firms are incentivized to keep the private equity machine running in any which way they can because it's become a huge portion of their investment banking fees. And so you you can already see it in the unwillingness of any Wall Street firms to ever criticize private equity or to issue sell reports on the publicly traded private equity firms. And so you can see that the Wall Street firms then will also be incentivized to try to keep this going in any way they can. And if they're the ones running the target date funds, then I can see that being an issue. And I can also see the collapse or any problems in the private equity industry actually becoming a larger problem for Wall Street in an interesting way because of how tight the linkages are now. What do you guys think of that? Is this me being a complete doomsayer?
I think there's a Chinese wall between the asset management and the banks, but the CEOs probably think that way. Right. But I think that, generally people know what's good for Wall Street, and private equity is very good for Wall Street. The more private equity, the better. You just, I think of this, like you think of this as a constant war. Everyone wants to make money off your retirement savings. And like Jack Bogle, gosh, that guy just eliminated such a huge profit pool, right? Just annihilated the active world, right? And so everyone's saying, well, how can we get some of that fee back? And like, why not private equity? Like, you don't need much private equity at 4, 5, 6% per year fees to get your entire thing back up to like what the active management total fee load was 20 years ago, right? Like, you can totally recover, if not more so, all the losses from indexing that have been inflicted on large asset managers if you can roll out private equity, right? It's such a fee generator.
Then every time I hear the word Chinese walls, I get allergic because, the Great Wall of China did not work. Why did not work in protecting against the invasions is because the Chinese generals from inside opened the door.
Right.
And so I think that there is a Freudian lapsus that everybody uses when they say there is a Chinese wall.
Yep.
Because you have this big construction that looks impenetrable, but eventually somebody always gets in. So yeah. I think that in this respect, I'm much more cynical than Bethany. But I am in a good mood today, and I want to actually be positive. And the positive is the following. So you run a newsletter that pays attention to this thing. So I'm going to call upon you to, number one, call out all the sponsors that stuff this in the target funds. Okay, so that now I'm creating readers for your newsletters, because all the 401k holders will read your newsletter to know if your stuff is in it. And second, to be a sponsor of a fantastic class action suit.
I think there will
be. Because there will be a class action suit. So the only way to protect our 401ks is to have a bunch of lawyers ready to jump on any 401k administrator who lets this touch a target fund.
Yep. I like
it. Everybody, you are on warning. Somebody is paying attention. Anyway, Dan, thank you so much. As always,
my pleasure.
It's a total delight to talk to you. Thank you.
This was a lot of fun.